A home equity loan is where you take out a loan against the equity that has been built up on your home that is used as collateral. Equity is the difference between how much you owe on your mortgage and the home's market value. This is not to be confused with a home equity line of credit, HELOC. A HELOC is a line of credit that is available to use as you need it, where a home equity loan is a lump sum that you will have to pay back over time. Home equity loans could have lower interest rates. A fixed-rate home equity loan could save you even more money. Home equity loans can be used for basically anything, tends to have fixed rates, and can be used as a deduction when you file for taxes. When pondering the use of your home and your equity as a solution to your debt, you should carefully consider all the options, which include a second mortgage, a home equity line of credit, or mortgage refinancing. Keep in mind the risks when you are applying for a fixed-rate home equity loan. The interest rate of a home equity loan could be fixed at a lower rate than that of a home equity line of credit. Still, the risk in taking out a fixed-rate home equity loan is greater due to the fact that you're taking out all of your home's equity in one setting. Plus, you must pay the entire amount of your fixed home equity loan if you decide to sell your home. If you cannot make the payments and default on your loan, then you face foreclosure. You will also have to pay closing costs, which could range from 2% to 5% of the loan amount. You could be making 2 mortgage payments if you are still paying the primary mortgage. You will need to have a high credit score depending on which institution will be granting you the loan. If you have gone over the other options, and you feel a home equity loan is your best choice, then the best place to start would be with a home equity loan quote. When getting a home equity loan, it is important to shop around and compare offers. Look to see if the interest rate on the loan is going to be a fixed or adjustable. Both these rates and advantages and disadvantages depending on your personal situation. Understand the loan minimum and maximum, which is the lowest and highest amount the bank will loan you, based on the equity in your home. There are many things to consider when taking a home equity loan. Do not get caught up in impressive websites, flashy advertising, or slick sales pitches. You will be putting your home on the line for these loans, so make sure to choose a lender with a good standing reputation. There are certain requirements that must be met when applying for a home equity loan. Lenders use what is known as a loan-to-value ratio, or LTV, to calculate the equity in your home. You can get this value by dividing your current loan balance by your home's appraised value, then multiply by 100 to convert this number to a percentage. This is important because lenders will typically only approve a home equity loan with an LTV ratio of up to 85%. You will likely need your credit score of 620 or higher. Lenders will also use what is known as a debt-to-income ratio. This is determined adding up all your monthly bills. Next, add up all income sources in the household, such as base income of both spouses, commissions, bonuses, and so on. Then divide your monthly debts by your monthly gross income. Usually lenders will want a debt-to-income ratio of 36%, but some lenders will go as high as 50%. You should go ahead and gather the necessary financial information that will be required for applying for a home equity loan. This information may include your social security number, unreported debts or support obligations such as alimony and child support, 2 years of prior employment history along with your employer's contact information, proof of your income going back the past 2 years, proof of home ownership and proof of home insurance, copy of your most recent pay stub, current mortgage statement, W-2 statements going back 2 years, an appraisal or valuation of your home, evidence of existing debts and existing liens on your home. When seeking out a home equity loan, you should be wary of scammers. Here are some scams you need to avoid. One is known as loan flipping. This is when a lender persuades a homeowner to get multiple mortgage refinances repeatedly. A major problem with loan flipping is the homeowner could be unaware that sum of equity can be used to cover any fees, closing costs for the refinance, and other fees associated with a refinance, such as an appraisal. This can cause your equity to go lower than the homeowner originally thought. The best way to avoid this scam is to limit the number of times you refinance your home. Avoid loan officers who approach you year after year to get you to refinance. You can always seek counseling through a housing counselor that is HUD approved before making any decision. Another far more aggressive tactic is known as equity stripping. This can end with scammer owning the home. This starts with the scammer pressuring the homeowner into a loan that they will be unable to afford to pay back, which ends with the home being foreclosed upon. A variant of the scam, the homeowner unknowingly sells the home to the scammer. This will allow the scammer to charge and raise rent. The scammer can also evict the homeowner if they are unable to pay the high rent cost. Individuals who are facing foreclosure or other financial hardships are the main target of these scammers. They show up at what seems like the perfect time, promising to let you cash in the equity you've built up without any consequences. So approach with caution when seeking home equity loans. There are also scams involving home equity for home improvement. These scams typically start with a home builder or contractor offering some kind of renovation services, such as a new bathroom or kitchen. They will usually quote reasonable prices. If the homeowner cannot afford the cost, then the contractor will put you in contact with a lender for a home equity loan. These contractors will then take your money and will do cheap, low-quality work on your home, usually causing damage that can lower the value of your home. If you wish to make improvements or renovate your home, you should be the one who chooses the lender for loan, not one some so-called contractor recommends. The same goes for the contractor as well. Never trust someone who comes to you offering services. Take the time to look for a licensed and insured contractor that carries a solid reputation. There are also predatory lenders who will use bait and switch tactics to get themselves a larger profit. These lenders will show you one set of paperwork as you are applying for a loan, but will hand you a different contract with totally different terms and conditions when it comes time to place your signature. These new terms and conditions will usually have higher fees and traps to make it more difficult to make your loan payments. This type of scam happens in every industry. For example, a car salesperson will get you to sign a deal for a car at a great price and a low interest rate just to come back and tell you they were unable to get that deal approved. When this happens, walk away right away. Lenders who use these tactics are going to keep adjusting terms in their favor in order to get the most money they can out of you. If you are worried about potentially changing terms while applying for a loan, speak with a HUD-approved housing counselor for assistance. A nonprofit counselor with a solid reputation will help you to spot scams early and avoid them.